It is a debt day. That's what we're talking about. Today's big number, $89.5 billion. That's how much Alphabet debt has been sold globally since 2025. Looking at shares of Alphabet, the Google parent in the equity market, the stock is flat, but had been under some pressure in the last 24 hours about a wave of departures. We'll bring you that story later on. I want to zero in on AI debt and get more on Alphabet with Robert Schiffman, Bloomberg Intelligence senior credit analyst. This is a $25 billion dollar-denominated offering, 10 parts, right? But it's the latest in a sequence of bond market activity. You write, borrowing fears, question mark. Answer your question mark.
Yeah, the answer right now is no. I think the second quarter prints that we saw for the biggest hyperscalers actually prove to people that all the money that they're spending is being monetized and the confidence levels have improved. You're seeing that with share prices and you're seeing that with bond prices. The demand for this deal, I think, is going to be substantial. What we heard already was that the books were at $65 billion. I think they're only going to issue $25 billion. So not raising it is positive. Obviously, their cost of capital is going up a little bit. But after increasing their CapEx guidance by $20 billion just a week or so ago, this shouldn't be a surprise to anybody. And quite frankly, I think they're actually front-running a lot of next year's borrowing. And this might actually help technicals going into 2027 versus hurt them.
On a US dollar basis, Alphabet, it's at $42.5 billion since 25. Amazon's $77 billion. You have done a really good job, Schiff, of explaining to the Bloomberg Tech audience why it's different in the here and now to say that the dot-com bubble, the financial crisis. Like, what do the balance sheets of these companies and their top-line growth outlooks differ from that period in history?
Well, these are real businesses that are generating cash, that are just spending more money these days to make more cash down the line. We're starting out with a tremendous amount of balance sheet flexibility. Alphabet traded AA+ at S&P. They're one notch away from the highest potential rating that you can have. And the rater said this morning they have $200 billion of net debt capacity within their current ratings. That means just to fall a notch to mid AA, they would have to issue another $200 billion of debt and spend it. So I think the flexibility that you see from, we've said it time and time again, these Mount Rushmore of credits, enables them to borrow as much as they want. And the concerns that people have been having that they're not going to be able to fund themselves as CapEx budgets go up by 50 or 100% next year, it's just not true. They can borrow, they can raise the money, the demand is there, the balance sheet flexibility is there, and people are now getting paid for it versus 2 or 3 years ago when you got basically no spread to own any of these names.
Robert Schiffman, Bloomberg Intelligence senior credit analyst, thank you very much.